Hi everyone, a very good afternoon. You're watching the newsroom on ET Now. I'm Mubina Kapasi. Markets are, well, climbing 0.7% higher for the Nifty and 0.9% higher for the Sensex, past the 40,000 mark for the Sensex, continuing to stay over there. Well, let's take a look at some of the movers and shakers and PSU stocks. Concor, NMDC in focus. We have an ET Now exclusive. The government is looking at buybacks in some of these big ticket PSUs. Coal India, NTPC, Engineers India is what my colleague Rushi Bhatia has understood from her sources. They may consider buyback soon, and in fact the government has asked them that you either spend on capex or reward shareholders. ET Now impact being witnessed on some of these stocks. Moving on to more newsmakers and stocks in news, take a look at the stock price of an Avenue Supermarts. We are seeing some nice momentum come by over there. The company delivered its second quarter numbers over the weekend, and well, it looks like an okay set. We have revenues that have obviously decreased from the corresponding quarter, but the margins have as well compressed 6.2%. Profit after tax down to 211 crore rupees, but nevertheless the stock doing okay. Moving on to Bank of Maharashtra, the company just delivered its second quarter numbers, and it's just doing okay at this point of time. The stock is surging 10% in trade, well, more than 10% actually, a massive momentum being witnessed over there post the numbers. Tata Communications revenues are flat at 4,400 crores, but there's been tremendous margin expansion, almost 300 basis points margin expansion, which has trickled down to the net profit as well. And finally, a stock I want to flag off, which I flagged off last week as well, is Amber Enterprises. The rally continues over there. It's 8% higher today as well in trade. So, just last week and prior to that government notification on imports, the stock was at 1,800. Currently, it's at 2,400 rupees. So, just in the last 10 days, we've seen a nice rally come by in the counter. Okay, well, from earnings, delivered to earnings expected, Britannia will be delivering its second quarter numbers. Let's go across to Vinny Motiwala to know what to expect.
Britannia is set to post its Q2 FY21 numbers, and it's the first FMCG company that's going to be posting its numbers. Now, last quarter also Britannia had outperformed other FMCG companies, and this time around, it is still expected to remain the fastest growing consumer staple company even in Q2 FY21. So now let's look at the numbers. Revenue expected to be at 3,527 crores, and it's expected to increase by around 16%. While in terms of profits, we are expecting a 24% jump in profits, and it'll be at 498 crores. Margins of the company are also expected to be at 18.9% versus 16%, and the overall EBITDA of the company is obviously aided by muted raw material inflation, cost savings, as well as operating leverage, which is going to be leading to a strong EBITDA for the company as well. Now, overall volume growth, very important number, so we are expecting a 14% volume growth this time around, mainly led by the strong growth in biscuits, bakery, as well as dairy segment of the company, because driven by higher in-home consumption. Now, normalization of inventory pile as well as market share gain are the other reasons also we may be seeing a volume growth of 14%. Overall, the strong growth is expected to continue in biscuits, bakery, and dairy products, but it is at a decreasing magnitude. As hawkers are coming back, we can go to restaurants now. So as things are opening up, things will be normalizing. So they are still growing very well, and they're going to be the fastest growing, but at a decreasing magnitude is what we are expecting. Now, factors to watch out for is, management's commentary on the demand trends, any raw material price outlook. This time it was benign, so what is the outlook going forward? And also in terms of any new product launches, as well as what are the marketing spends idea, is something that we're going to watch out for from Britannia.
All right. Thanks a lot, Vinny, for that. Well, apart from Britannia, we also have ACC that will be delivering its quarterly numbers. Okay, what to expect? Well, the revenues are seen at 3,370 crore rupees, down 4.5%, while the profit after tax is seen declining 7.5%. Largely, or at least Citi believes that the volumes and realizations are going to be flat, but there is a rise in pet coke prices and diesel prices, which may increase cost of production. What sort of sequential volume performance do they deliver? What is the improvement from the previous quarter will as well be very closely watched out for. ACC, in fact, will be one of the first few cement companies to deliver their quarterly numbers, so all the more will be watched out with a very close eye. Okay, and moving on, SP Group's bid to restructure their loan is going a step further, as no solution is in sight for the group's stake in Tata Sons. ET now exclusively learns from its sources that lenders to the Shapurji Palunji Company Limited will be invoking an inter-creditor agreement this week. Priyanka Iyer joins in with the details. Priyanka, tell us, what are you picking up?
Well, yes, ET now has exclusively learned from sources within the banking industry that an intercreditor agreement is going to be invoked this week amongst the lenders to SPCPL, which is Shapurji Palunji Company Private Limited, the holding company. And this is, of course, for the restructuring of their loans, which have been impacted due to COVID-19. Well, what we are understanding is that once the intercreditor agreement is signed by banks, there are multiple banks which have exposure to SP Group. Then the contours of the resolution plan will be worked upon. This resolution is, of course, being done under the COVID-19 related framework for stressed assets that was put out by RBI. So further, the plan will also be put forward to the KV Kamath committee. But at this point, what we're picking up from sources is that banks are considering multiple ways for the restructuring of these loans. A few of these will be deferring installments, restructuring existing liabilities, converting short-term loans to medium-term loans, and the banks do not at this point envisage any haircut or loss for themselves as part of this restructuring. We also reached out to SP Group, but we have not yet received a response from them on this matter. Remember, SP Group wanted to pledge their shares in Tata Sons, their 18.37% stake in Tata Sons, but that was not allowed by the Supreme Court. And the matter about their stake in Tata Sons is, of course, sub judice. The next hearing is on 28th of October, but SP Group went ahead with the restructuring because of the impact that the businesses have had and to be able to sustain their businesses. So, of course, the ICA is being signed now. We're also understanding from sources that banks will consider making a consortium so that it's easier to go ahead with the restructuring and resolution of the loans and liabilities of SP Group.
Thanks, Priyanka, for that. Moving on, resolution professional of Jet Airways, Ashish Acharya, tells ET now the lenders have approved the resolution plan in which they will remain invested in the company, both via debt and equity. Also insists that the next step is NCLT approval to revive Jet Airways back to its glory. That's an ET now exclusive. Listen in.
The company obviously has to, do a resolution or a settlement for the creditors which were there, before the company shut down, and then of course new capital that needs to be introduced, for the revival of the company. So the business plan that has been submitted by this Jalan Calroc consortium, they have provided for both these aspects, and the lenders in their commercial wisdom have now approved the plan. So after the few more formalities, I think, we should be able to, the plan is to have this airline back in the skies soon.
Okay, on that note, we'll take a very short break right here on the show. Welcome back. You're watching the newsroom on ET Now. Times Network Special Investor Education Initiative Nivesh Ke Fande seeks to guide investors on better managing their financial portfolios and also provide them with simple explanation on how financial products work. On this edition, we are looking at ETFs, or exchange traded funds.
One investment avenue which has been gaining popularity over the last couple of years has been exchange traded fund, or ETF.
That's true. Now, ETFs are funds that invest in a debt or equity index or commodities like gold.
Yeah, their expense ratio is low since they are passive investments, so they're available at a low cost to investors.
For example, an ETF that's based on a market index will invest in stocks of the companies in the same ratio as they're represented in the index.
So the performance of that ETF will rise and fall almost identically to the performance of that index.
To invest in ETFs, an investor will have to have a demat account, as they are bought and sold through the exchanges.
And this very aspect makes ETFs highly liquid, since they can be bought and sold like regular stocks at any given point of the day.
So do consider adding ETFs to your portfolio. That's all from us on this edition of Nivesh Ke Fande.
All right, well, let's move on now and bring on board Venkat Ramaswamy. He's the VC of the Edelweiss Group, and Edelweiss is going to raise 6,600 crore rupees in an AIF. It's one of the largest fundraisers in 2020, by an AM. So, Mr. Ramaswamy, thank you for joining us today on ET Now. So, the asset management firm has raised 6,600 crore rupees in an AIF, and like I was saying, this is one of the largest raises in the year by the Indian private credit space. So, talk to us about this fund, the opportunity in the private debt space.
So this fund is our third fund in this category. This basically invests in corporates in India. Our first fund was ESOP 1, Edelweiss Special Opportunities Fund 1, was 10 years back, and it was about 1,000 odd crores. The second fund was 5 years back, which is around 2,000 crores. This one is around 6,600 crores, 900 odd million US. This is a credit fund which helps companies get growth capital, but in the form of credit. This is structured as long-term patient capital, because we provide these credits for between 3 to 5 years, 5 years typically. This is a closed-ended fund, so meaning we have to return the capital to our investors only at the end of 5 years or around that time. It is structured as to try and provide credit solutions for growth-oriented companies in India. So that is the focus of the fund. It is expected to be, it is good to say that it is the largest, but the year is not over. But it is expected to be the largest alternatives fund in the calendar year 2020 for sure in India, by the looks of it.
All right. Well, let's also talk then about the fact that Edelweiss AMC has a total of 75,000 crore rupees of AUM, of which 40% constitutes the alternatives AUM. So given the growing credit market and the data indicating outflow from the mutual fund industry, where do you see the share of alternative business rising in the near future?
We are seeing not much outflows. So if you look at our mutual fund, the Edelweiss Mutual Fund, it has actually grown meaningfully in the last 12 months. And our client or customer solutions oriented approach to building products, which include things like Bharat Bond 1, Bharat Bond 2, and then we recently launched Edelweiss MSCI Global Healthcare product. This has led to our AUM actually not shrinking. It has increased over the last 12 months. Our current ratio, if you look at Edelweiss Asset Management, it has two businesses, the mutual fund business and the alternatives business. Together, they constitute around 75,000 crores, which is about order of magnitude $10 odd billion, which is 60-40. 60% is mutual fund, 40% is alternatives. I continue to believe that over the next 18 to 36 months, 18 to 36 months, both these businesses have a lot of growth plans. And I do believe that the ratio may not necessarily change meaningfully. Though we will launch large private credit funds even next year and yield funds next year, I do believe that our mutual fund has meaningful growth plans and has an exciting future.
All right. How do you see the yield shaping up in India versus other economies? How are you analyzing the appetite of global investors in India?
Reality is that India yields or India credit yields are very, very attractive at this point of time compared to pretty much every other large geography in the world. And because India continues to have and may continue to have 4 to 6% inflation, plus India is a meaningfully credit-starved economy. What happened over the last 2 years with NBFCs and then with mutual funds, with their ALMs, the opportunity for credit funds which are structured without ALM and which are not levered is meaningful. So I do believe that, and this happened in the US or in the global markets immediately after the GFC. So if you look at 2009-10, that is when large private debt or private credit funds started coming about world over. And this is the time for India. And I do believe that large opportunities will bring more players, and attractiveness of yield will continue to be so with respect to India over the next medium term for sure. Because I don't think yields globally are going to come down in a hurry. If you hear what Fed is currently indicating, I don't think yields are coming down in a hurry or going up in a hurry. Sorry.
So what are the future plans then for the Edelweiss alternative business? Can we expect more of such funds, and which segments will you be looking at?
So in Edelweiss Alternatives, we run 4 strategies: distressed credit, corporate performing credit, real estate performing credit, and infrastructure yield, which is real assets. And this last year was, or 18 months back, was our distressed credit fund, which is meaningfully invested. This year has been our performing credit corporate fund. I do believe in the next year, we will come out with probably the real estate fund, maybe even the infrastructure yield fund, because all of these funds are at this point of time investing at a reasonably fast pace, because the opportunities are large and very, very attractive at present in India.
Okay, well, thank you so much for joining us then today on the show. And with that, we'll wrap it up. Thank you for watching.